No, it's so late. Okay, we'll try to do a fast game.
Yeah. I have a hard stop at 11. We'll do something.
Okay. Hello, hello.
Hello.
Are the bootcamp people joining?
I've sent the link into their big chat. I think they should be. Fabian. Hello. I think Claire should also be coming. Wait, Javier, to save time, do you want to set up your memo screen first?
Yeah, sure.
Okay, we'll give the rest 1 more minute. Okay, Javier, I think we can start.
Okay.
Yeah.
Hi everyone. I'm just gonna share like a piece that I wrote on Spotify. It's like the full like investment thesis and valuation. I think this could be quite a good buy right now. Yeah, so the basic story for this is that I think it can hit profitability by 2025. And it's quite achievable. Yeah, so Spotify, I think you should be quite familiar with the business. Largest pure play audio streaming service, and they are driving and benefiting from the ongoing secular shift from transaction-based to access-based streaming models. Uh, they are currently growing their total MAUs at about 27% and generating positive free cash flow on an annual basis. So even though last year they achieved, or not achieved, but they suffered quite a huge net loss of 430 million uh euros yeah last year. I think that the outlook for them is actually promising and the stock is currently trading at a discount. So my view on how they can achieve profitability is driven by three main things. So firstly would be their ability to improve their unit economics, and this will be split down into further drivers later. Secondly would be that they can sustainably improve on their operating efficiencies. And thirdly, they have a decent moat which can help them to stave off competition. So firstly, on their unit economics, I think a big thing about Spotify is that people have been scrutinizing their business model for a long time as to whether they can actually like successfully improve their margins. People think that they've been getting squeezed by the music labels and publishers, but I think they actually do have that bargaining power to negotiate for no lower revenue sharing and whatnot. But okay, let me just go into more detail. So, so unit economics can be broken down into two main components, right? So firstly would be the price and then the cost. So for the price, I think that they do have the significant ability to monetize their user base better and basically increase their prices. So over the years, they've shown that their subscriber base has been able to absorb price hikes with minimal impact on MAU growth or MAU like churn. And in the past few years, they've conducted over 50 price hikes, just not in the major geographies, which is like Europe or US. They've like conducted these like price hike trials in some of the smaller markets. But yet, as of Q2 2023, the MAUs have increased by 70% since the onset of the pandemic. And in July, they announced the first major price hike in their major markets. So basically all these increased by about $1 or so. So prior to the price hike, their ARPU was only at $56 per year. And with the average disposable income per capita in the US being about 60,000, this means that each Spotify subscription, per year takes up only about 0.09% of your wallet share, which is, quite like not very significant. So, to examine how their user base actually reacts to subscriptions being anticipated to take up a larger proportion of wallet share, um, basically how they could be reacting to the current price hikes. We can look at Q1 2020. So this is the COVID quarter, right? So US unemployment rate spiked from 3.5% to 14.7%. So when you lose your job, you anticipate that, okay, I'm gonna lose my income, my disposable income is gonna fall. But yet, during that quarter, they saw the fastest year-on-year growth in MAU. Sorry, forgot to define what is MAU. So MAU is monthly average users. Yeah. So they saw the fastest year-on-year growth in monthly average users in 3 years at 32%. There was also no slowdown in premium subscriber growth. So for them, they have premium subscribers and like ad supported, like advertising supported subscribers. So for these premium subscriber growth, there was no slowdown observed also, and the subscribers jumped by 30% that quarter. So what this is telling me is that this user growth is not so much a function of like employment or income. So basically like whatever macro factors that we usually care about, right? But it's more of just how consumers decide to spend their money, right? It's not a super expensive thing. It's just really whether they want to make this purchase every year or not. So yeah, a matter of taste and preferences. So with the recent price hikes expected to only increase the average wallet share from 0.09 to barely above 0.1% is really like almost insignificant. I don't think that as in, I think that this change will be immaterial to their loyal customer base, and with the kind of product offerings that they have, it will justify the price increase, and their customer base will be able to absorb this this price hike. And so second will be on the cost side. So I think they can continue to lower their direct costs by leveraging on their massive scale. So basically they are the largest music streaming platform in terms of users, and they really outstrip the next competitor, but which is Apple Music, by almost 2 times, right? So their direct costs comprise mainly of revenue sharing with the labels and publishers for both their premium and advertising revenues. So like this basically this would be their cost of goods sold, right? If you want to think about the income statement, and this makes up 84% of revenues. So but you can see that for Spotify, their pay per stream on average has been trending downwards, and in the past decade, this pay per stream has actually halved from 0.006 to 0.003. And I think this is attributed to the sheer number of years or just users that Spotify managed to attract to their platform. So when you have more years on your platform, you do have that bargaining power to kind of negotiate for lower revenue share with these publishers, because um if you kind of threaten to like not partner with them anymore, then they also have nobody to listen to their music, right? So it is kind of like a win-win sort of thing. So the market has expressed concern as to whether artists might churn from Spotify because maybe they are not earning enough if you don't share the revenue from streaming with them. But I think this is quite unlikely, because there's zero incremental cost for artists to upload their works to Spotify, right? Like it's basically free to upload your songs there. So if you leave the platform, it will only result in a loss of exposure for them. So I mean, you have to understand this demographic, right? They're like, I mean, not in a negative way, but a lot of them are like starving artists. They need that exposure in order to, increase their fame. And then, they can actually make money in other ways, which is actually what Spotify is trying to do. So to ensure that this artist welfare is protected, they have introduced other, methods beyond music streaming for them to make money. For example, you can integrate your Spotify account with Shopify to sell merchandise like T-shirts and whatnot, and to kind of visualize the impact that this could have for them, right? Usually you earn about 0.003 to 0.005 per stream. So to make $100, you need 25,000 people to listen to your song or podcast. But if you're selling merch, you just need 5 people to buy a $20 t-shirt from your store to get the same amount. So, this is honestly a much more efficient way for them to gain revenue. There are also other things like ticketing promotion and fan support. Yeah, but I think the biggest thing would be like the merch integration. Yeah, so I think as a whole, artists are still like okay and can earn a living from being on Spotify. So know that supplier side is kind of managed well, right? Um yeah, so I think being a first mover in this space serves as their moat. It doesn't seem like any of their competitors are making the same moves. So I think they can continue to cut their largest variable cost, which is this revenue sharing, and their gross margins should improve in the future. And yeah, just to add on to this point, like they also are currently expanding in their podcast business, right? And they have said that the podcast streaming has the potential to be a 50% gross margin business. Currently, their gross margins are like 20 plus percent. So, in the long run, I think their gross margins have a lot of room to grow. And management has said that they're on track to improve their gross margins. So, it's quite positive for them since this is their biggest like turn-off point for investors. And to examine whether there's a flaw for the revenue sharing, like how low can this actually go, right? We can take a look at Deezer, which is a competing music streaming app. So they currently have a paper stream of only 0.01%. So that's like one third of Spotify, right? But from Q1 21 to 23, the share of digital music buyers using Deezer still grew by 7%. So, what this tells you is that as long as your product is good enough, artists stay on your platform, people still come to your platform. So, there's a lot of room to kind of decrease this cost. Yeah, so these are some of my assumptions. And then after that, I think they also have room to improve their operating expenses and whatnot. So in the last two recent quarters, they've highlighted some efforts to streamline their operations and reduce costs. Year to date, they announced they're laying off 8% of their global workforce, so about 800 people. So, if we just do some analysis, assume like a 2% wage growth, by cutting off this amount of people, they'll save about 100 million euros, which is a quarter of their 2022 net losses. So, quite significant. And they are also quite cognizant of their overinvestment in content deals, basically mostly in the podcast space. So the weak margins in 2022 were attributed to these investments in the podcast business, but they were mostly investments in marketing expenses and exclusive content deals, which by nature will be front loaded and then moderate subsequently as seen as in their core music streaming business. And I think this is actually okay because for like a music streaming business, there's not really a lot of it's not a super deep mode, even though they do have their like other ways to make money for creators and whatnot. But in terms of the actual content that you provide for the listeners, music is gonna be the same, right? Whether you listen on this platform or another platform. So what really drives the consumption is really marketing. So they will need to spend more on this like at the start, which is what they're doing now. So I think it's justified. Um and then during the 2022 Investor Day, oh yeah, so I mentioned this already. So the 50% gross margin business, and this is expected to play out over the next 5 years. They said that they're on track. So yeah, that's good for them. And they've explicitly came out to say that okay, operating expenses as a percentage of revenue should come down. They're not gonna increase it to the same extent that they have had in the past years. So operating expenses are things that are like well within your control. Like you can decide like how many people you want to hire, how much you want to spend on marketing. It's not like things that are can be very volatile or like out of your reach, right? So for this kind of things, usually when management says that oh we are gonna lower it, means they're gonna lower it, and it's something that you can probably bank on. Yeah. So the third point will be about like how I think they can survive against their competition. So, the next largest, as I mentioned, is Apple Music, and they are 2 times larger than them. So, if you look at some online reviews, audiophiles, which are like the huge music or audio like fans, they'll say that Apple Music actually has slightly higher music quality because they provide like the lossless music. So, but I mean, I believe that for the average listener, I don't think there's gonna be like a material difference like when you listen, Spotify versus Apple Music. I don't think there's gonna be like the key differentiator. At most, you're gonna have like those super big music fans churning to Apple Music, but as a whole, I don't think the impact is that huge. So instead of like investing in their audio quality, they've been investing more in like their product offerings, like in the podcast space and whatever, like securing exclusive partnerships, spending on marketing, which I think like on an ROI basis is probably better for them. Um yeah, and I mean especially for like podcasts, right? But like is the audio quality gonna have that much of a difference? So I don't think so lah, like for the experience. So yeah. And then for the expansions in the podcast space, they were the most preferred podcast application, a third of US podcast listeners, and 21% increase in audience share since September 21. Apple again follows behind. Other than that, there's no like other competitors that we really need to worry about. Yeah. And I think the thing to note about Apple Music is that they really only have a chance within the iOS space. So if you look at the Android market, right, which and Android dominates with 70% in this OS space, right? And yeah, so Apple is a lot less popular in this Android market if you look at the downloads. So Spotify has like over 1 billion downloads and Apple Music is 100 million. So, Spotify is like 10 times more popular than Apple Music in the Android space. So, I think just by nature of the product, like Android users won't go and use Apple Music. So I think again that could be a moat for Spotify. And yeah, it's hard for other players to kind of compete there. Break-even analysis. So I just wanted to see like how easy is it for them to turn profitable. So, assuming a couple of things, I won't go through the details. But basically they only need to grow their users, their MAUs at 8% CAGR over the next 3 years, which is very achievable. And it's much lower than the 3-year historical CAGR of 22% or last quarter's growth of 27%. So 8% seems very, very manageable. Yeah, if they can do this over the next 3 years, then yeah, they'll hit profitability. Valuation currently looks pretty cheap, about one standard deviation away from the historical mean. Yeah, these are some of the valuation and the target price. 3-year target price, 120% upside. So I would say this is a buy at the current prices. Yeah, I think if there were any key risks, it would be, well, perhaps like the macro. But then again, I established that no, the macro should have that huge of an impact. So honestly, I don't know what's the biggest risk. It could be like competitors going more into the podcast space, and then they kind of lose their advantage there. But I think quite unlikely because they are the first mover. They've already got like the most product offerings. So even if competitors try to play catch up, they'll still be constantly growing. So in this kind of thing is very hard to grow that much faster. Like yeah. So just to conclude, I think this is a good buy at the current prices, and yeah, I'm open to questions. Yeah.
Thank you. It's really interesting stuff actually. Actually just to like I'm just gonna ask a few questions and see if anybody else has questions. But yeah, I think on the competitor side, so like besides Apple Music, what do you think about like Amazon Music and like YouTube Music? Because these are all like kind of players that already have services and a lot of customers from like other kind of like you have like Amazon Prime or you have um like people on YouTube anyway, and especially if they want to do stuff like video like podcast, I think like what do you think about like the threat from these kinds of players other than Apple Music?
Um, yeah, so I think the thing you should know about like the next few biggest is that
Mhm.
music is not their main business. Like even for Apple, like
Yeah.
why does Apple have Apple Music? It's more like just to enhance the Apple users' experience, in their Apple ecosystem. And for them, Apple Music is not a money-making business that they're actually, losing money on Apple Music. So, and
Mm,
that's been happening for the longest time. I don't think uh they have much better things to do than like focus on Apple Music. So, I mean, and for reference, Apple Music is like less than 2% of Apple's total revenue. It doesn't make sense to me that they'll suddenly channel efforts into Apple Music. And same for like huge players like Amazon, Tencent, YouTube, which is under Alphabet or Google, right? So I don't think you really need to worry about it.
okay.
The point about like video podcasts, I think Spotify has introduced that as well. So not that, no advantage there for them.
Okay.
Yeah, yeah.
Yeah. Okay, on the podcast investments, I think a lot of the bears are like disappointed that they invested like 1 billion into it, but they don't see like a lot of returns from that. Like, what do you think is the like biggest like thing holding them back from generating returns on this regard? And what do you think is an acceptable timeline for them to for the podcast part to really take off?
Did they say that they're not generating returns on it? I mean, management has said that they're on track towards
On
this 50% gross margins. I think
papers.
the podcast is actually doing okay.
Okay.
Yeah.
Yeah.
Acceptable timeline. I mean, their guidance is over the next 5 years they can hit 50%. And I think if they can actually hit that, it'll be honestly that's my bull case. I don't know, 50% sounds very high. But then again, like SaaS business, 50% gross margin sounds achievable, so I wouldn't be surprised. And I
Yeah.
think the reason is that like for podcasts, they don't have to like liaise with the labels. It's more of like individual podcasters. That's why they don't have to like give them so much money. Yeah.
Okay. Are they gonna dial back on the investments? They said something like that, right?
Dalbert, yeah, I guess they're just being more like careful and strategic,
Mhm.
especially with the like ongoing macro and stuff.
Okay.
Yeah.
Yeah, yeah. I think one last thing, like on the like you predicted 4% increases in premium ARPU, right?
Oh,
Yeah.
yeah.
What do you
Okay.
think is gonna drive most of that? Are they going to introduce like is it just gonna be they're gonna increase the price hikes and then what are they focusing on anything very very um like I saw that they have some DJ function which is pretty cool where they like
Mm-hmm.
give you like your own personal DJ in the corner and then you can like have this station that's catered to you. Like is that one of their like main things that they're trying to like draw more people to premium? Like do you know anything else?
Okay, those are kind of two different points though. Like, I think the ARPU growth, yeah, is driven by um yeah, the price hikes and possibly like the product mix also. So like how Spotify has different plans, like the family plan, student plans. So
Oh,
they've been making efforts to kind of drive people more towards like the more uh like the premium plans and more like value-added plans, I guess. Yeah. And the point on the DJ thing, I guess that's one of their selling points in terms of like how they are using AI
right.
to their advantage. And I mean, honestly, I don't think that's like a huge thing. They just want to add AI as a buzzword to their earnings call, and all the tech companies are doing it. But I guess it's like a cool like novelty feature, but wouldn't be like the main like
Okay.
driver of anything. Yeah.
Okay. Yeah. So that was I think one last question. Did you take a look at like the music streaming industry in China? Because there was some very intense
Um.
competition between TME, NetEase. I think although TME is like I think 70% market share,
Mhm.
but like I think it'd be interesting to kind of look at how it kind of weathered a lot of like deal making. I remember back then they also wanted to have a lot of like indie artists on TME. They were fighting over that, but I think now the dust has settled, and then this is kind of the situation they have right now. But did you take a look at least the industry in China?
Um. No, because Spotify is not available in China, if I'm
Yeah.
not wrong. Like they're blocked, right? So I mean, doesn't really affect this company.
Oh, okay.
Yeah.
I think yeah, but I think it could be an interesting reference point. Not to say that there's a playbook for Spotify to follow, but more I don't know. I think because that's the only like only exposure I ever had to music, like looking at the music streaming industry. But yeah, but that's just a very
Um,
like small kind of thought that I had. Okay, does anybody else have any
yeah.
questions?
Just curious because like the revenue is generated from the premiums or the advertising fees or generated from the like derivatives selling. Like for example, you mentioned selling the t-shirts through the link, but like how they get the payment about the copyright of the song, like the show will the platform pay for the singer because they use their song to make the money, or will the singer pay to this platform because they post their thing in the platform?
Oh,
So that,
yeah. So, okay, no, it's free to post to the platform. You don't need to pay anything. So,
oh,
yeah. So, the artist will get paid if they're signed to like the label or the publisher, like what's an example? Like Warner Music Group or something. Then Spotify will pay them with this revenue sharing, and then you get paid accordingly to your like artist contract or whatever arrangement that they have. So yeah, that's how the kind of money flow works.
oh, I see. Yeah, thank you.
Yeah. Okay, sorry guys, I kind of have to go for
Well,
something. I have a meeting at
but thank you
11.
for your sharing. Yeah, I think
Yeah, no
for the rest
problem.
of tonight, I know it's getting very late. So I think Nijin, could you run us really quickly through your Costco updates?
Yeah, sure. Is there anything other than my update?
No.
Okay, sure. Yeah, I can make this very quick because it's really to answer some of the questions that you guys posted at our last meeting. Yeah, I think just a general update. And yeah, I think they initiated the position. Actually, I think there's an error. It was down and not up. I think because it recently retraced a little from 560. So I think there's an error in that. But yeah, okay, let me share my screen. One second. Yeah. Can you see
Yeah.
the screen? Yeah, just to run it through quickly. I think generally, I think some of the questions include expanding into China. I think that is one of the things that I was looking at as well. I think there's an interesting trend. Generally, yeah, right now there's about 11 different chains in China that is looking at warehouse clubs. And yeah, some of them being Yonghui Superstores and Alibaba Freshippo. Yeah, and the sales are in this club more than doubled in 2022 versus 4 years earlier. Yeah, however, even though there's such big growth in sales, right, membership warehouse stores only account for like 0.3% of sales in the grocery sector. So most of them are still looking at this chart, right, part of the supermarket or hypermarket chain. So warehouse membership cards still take a small proportion. And yeah, looking at the growth rate, is growing a lot more significantly than the traditional supermarket. Yeah, so I think COVID did something to it, but yeah, people are looking for better deals and having a ready stock of groceries. Yeah, and I think looking into China, some of the market leader is Sam's Club, which is under Walmart, which has around 44 stores, whereas Costco has only 4. So I think the key difference between some of these international companies versus Chinese warehouse companies, right, or retail companies are that they have different value propositions. So for instance, Alibaba's Freshippo, they target China's youngest digitally savvy urbanites, and yeah, they have different products that's available for them. For instance, like Japanese products from different or fruits from different Chinese province. So yeah, for themselves, they actually targeted. They aim to target themselves by focusing on the smaller and less affluent cities. And I think looking at some of these international warehouses, right? I mean, from a report that I was just reading, I think there's a perception, perhaps, yeah, that there's higher quality for international warehouses, and whereas local warehouses stock more local brands. And for the benefits, or rather the strengths of these international warehouses, so with their global supply chains and some of their exclusive labels, and for Costco will be their Kirkland signature. Yeah, and yeah, that actually gives them an advantage in this case. So yes, I think one of the other competitors that I was looking at was Yonghui Warehouses, which is over 100 plus retail warehouses. They also operate within the supermarket space. However, they are closing down many retail stores, the normal traditional supermarket one. So it seems like there's a shift in the way supermarket is operating. And so what they do normally when they're transitioning to these warehouse clubs is they renovate their existing stores to have the same concept of a membership store such as Costco. Whereas Costco, on the other hand, right, is selecting locations, so they are able to strategically choose places where they want to put their stores in order to capture the biggest market. So I think that is the difference also for the local supermarket stores versus Costco. Yeah, and I think again another pivot towards warehouse stores. And yeah, and I think one of the pressures that's coming is really from e-commerce lah, and the whole I feel like the whole industry is pivoting. Then going to be a bit more for their own, looking at Costco internally, I think for membership fees changing, all the things that was brought up. So generally they average a change every 5 years and 7 months. So working back to June 2017, right, the next price hike is supposed to be the start of this year, 2023, but that has not really happened generally because of inflation and recessionary fears. Yeah, and then them seeing that they have enough leverage out there to drive the business. And despite this inflation, both its household members and cardholders also spend more money, about 7% more over the last year. Yeah, but nevertheless, they are not afraid to raise the prices because even with the additional considerations that the extra revenue can be used to keep prices low, like translating it to for the consumers. And yeah, another point on e-commerce cannibalization, because I think that is one area that they have been also exploring. So actually, it's not very strong. I think upon deeper research, right, they do not actually offer. They're very slow on offering any sort of e-commerce. And mainly, I narrow it down to 3 different areas. And I think one thing to note is that e-commerce sales tend to rise on specific occasions like Black Friday, Cyber Monday, Thanksgiving, and all of these are coming in November, so actually coming out at the end of this year. So generally, they see a massive spike in e-commerce sales during this period. And so of the 3 different ways that e-commerce happens, I think one is placing pickup lockers at Costco warehouses and then picking up online. So this one doesn't really cannibalize anything. Moving on to the next one is Costco Next. So they allow consumers to also buy from their suppliers. So they create a limited supply of items, right, that consumers can buy directly from their trusted suppliers. So generally these are below standard cost, about 20% below, and they also encourage them to stay with Costco and also browse online for deals. So I think the benefits rather for Costco in this case, rather than it cannibalizing their main revenue drivers, is that it helps them navigate the supply chain crunch where 79% of its imports generally are late. So this also to appeal to that side of things. And for the third point, for delivery, they also do delivery of shipments through Costco Logistics. Partnering with Instacart to have same-day delivery for bulky items. And one thing to note on this is that non-members can actually purchase items on Instacart. So so that's the only one of the few ways that non-members can purchase items without paying the $60 or $120 benefits or $120 membership. But it won't happen because mainly it is people who use this service are looking for a one-time off purchase, and beyond a certain amount of purchase online, it'll make more economical sense, right, to get just the Costco membership. And doing some numbers to see how it makes sense, I think so just to explain a little bit more on the difference between a $60 and $120 membership. So first one is just a $60, the general membership, and for $120 you get a 2% cashback. I think that's the main benefits. And in order to make it worth, generally people have to spend about $3,000 a year and about $250 a month, which is actually not a lot considering that most of the things that Costco sells are in bulk. And even if they don't earn enough, so they don't spend these $250 a month, right, to make back that extra $60, Costco will refund the difference. And then the question asked, right, that why don't everyone just buy the $120? I think it's just a lesser known fact that people don't really know. Another place that people can shop without membership is through the Costco shop card, which is basically a gift card, but only can be purchased by members. It's just a $25 gift card. So again, nothing very significant, and people won't, if people are interested in buying more things, they won't go through this way. I think another thing, looking at the SKUs, I think one of the, just to dive deeper, nothing really new here. Costco maintains about 4,000, slightly less than 4,000 SKUs, and they sell at large volume. So basically, having a lower cost and also passing it down the savings to the consumers as well. yeah, so generally just to update, I think there's nothing really significant here or new. And moving on to the competition, I think looking at, let's say, the biggest competitor, Walmart, Kirkland, or rather the Costco private label, right, marks out about 15% above its cost. And looking at Walmart's financials, gross margin is about 24%. So doing the math, they generally have a markup of around 30%. So the difference of 15% that Costco has to sort of navigate in order to make to be competitive. Yeah. So again, if you do the numbers, taking $60 as the membership, yeah, they have to just really spend about $400 a year and $34 a month. So looking at it is very competitive versus other retailers. And going back to returning of membership fees, I think that was something that we discussed last meeting. They are very focused on customer satisfaction, and people, if they are not interested or if they really feel that they are not happy with the service, they are able to just return this membership. Yeah, and the most common one is people abusing it, like after buying items for a while and then they just return it. But after a while, after such multiple such behaviors, right, Costco will just revoke them. So that is for returning of items, but returning of membership has not frequently happened, and it can be assumed that customers will face the same consequences if they try to do so, and they themselves benefit from low prices, so it doesn't make sense to get this membership revoked. Yeah. So, and I think one of the questions that was asked also whether their expansion involves like direct selling or franchising, right? I think they own all the stores, and there's no franchising. Yeah, and this is just a breakdown of Costco sales, nothing too new as well, with food and sundries and fresh food making the larger portion of this. Yeah. So I think generally the main update is also on how the plans of Costco, expansion plans of Costco, and which includes the expansion into China. I think that is the key area, the key part. Yeah.
Okay, just a quick question on expansion. So they're mostly focusing on Shanghai, Tier 1, something like that, right?
Yeah, I think the general focus is on the middle tier urban cities. Yeah, because I think the focus is on bulk purchases. I mean, from their business model, so it wouldn't be they're not selling individual one by one products. Yeah.
Okay. Okay.
Yeah.
Yeah. Overall looks pretty good. I think you've sort of convinced me that Costco offers value like no other. But does anybody have any questions for the update? I think we can add this to the folder then. Did you see the link that Shunya shared? The Acquired podcast, was it?
Oh, I haven't had a chance to look at it yet, but I think I was quite I'll probably take a look. I think since he was really excited after hearing about it, and
I think it talks about stuff like how Costco battled a lot of its like the other grocery chains and like kind of like found its way as like the membership model, the target value, like offer value. I think if you have time, I think you can check it out. And then anything to kind of just add to the analysis. But in the meantime, since it's already one of our holdings, I think we can just keep our eye on it. Just I guess look out for any like interesting news, and then without like a lot of financial data, we can't really do anything. But I think in the meantime, kind of just look at some of the assumptions we have and see if we can find any more data, especially on this China expansion thing. Because I think right now the market still looks quite green, looks quite interesting. Doesn't seem like an easy thing for Costco to do, but I think it's very exciting. I think you can take a look at how exactly they might go about like what exactly might be challenging and then how they might overcome that. But yeah, really good work. Thank you for the very timely update. Yeah. Does anybody else have any questions? Oh, run fights. Popeyes versus Chick-fil-A. Okay. Yeah, okay. Yeah, if so I think just plop this in the Costco folder, or you can look around the wiki. I think there should be a page just for your memo, and you can put it there. And then for the bootcamp members, yes, I will grab the documents that they have, and then I will plot them in the Telegram channel because they're not on lock. But yeah.
Sure.
Okay. Yeah,
Okay.
it's getting kind of late. I think thank you everybody for staying up. So like if you're wondering why it's starting so late, it's because they especially I think the ERP side, they gave some feedback that they wanted to start a bit later so that they could have dinner plans, which is both a good thing and a bad thing. It's a good thing for your social lives, so now you can have dinner plans on Sunday night. But yeah, just we always try to keep it kind of short and sweet, and then if any other follow-ups we can always chat in the group. But yeah, if you guys have any questions, can also let me and your new deputy CIOs know. But yeah, if there's nothing else, then that should be all for tonight. Okay. Yeah, thank you
Okay.
guys for sticking along so late. We'll see you soon.
Bye bye.
Thank you.
Thank you. Bye bye.